You are now listening to The Big Trade with Peter Pham, enlightening conversations for maximum market returns.
Gary, you just mentioned about markets and how eventually markets will unfold or reveal what's actually happening in terms of the world economy. You also mentioned the involvement of bureaucrats. I heard you mention many times previously about oligarchs, plutocrats, and technocrats. Can you first off describe what these entities are and what their role and involvement are in terms of the world economy, geopolitics, for the audience?
Well, I've written quite a bit about wealth inequality, and it's starting to get a lot of attention in the broader media. And especially in the last few years, the gap between the ultra-rich, which I would say is the richest 1/10 of 1% of the world's population, the wealth of the world's wealthiest 1/10 of 1% has as much wealth as the bottom 50% of the world population. That is an extreme inequality, and we have to keep in mind, even in today's world of the internet and blogosphere and podcasts such as we're doing today, and even my newsletter, I think that we have the ability to communicate in various ways individually on our own, and we have still today a relatively free internet world marketplace. We also should keep in mind that the major media broadcasting corporations are controlled by corporations who are part of that 1/10 of 1%, the owners of these corporations, and the folks that work with them on the board of directors are basically letting the population know what it is they want them to know. A lot of people may be very frustrated when they turn on the television and all they hear is relative nonsense about things that don't matter in anyone's lives, and perhaps the market is a way, the news media is a way to get into an alternative universe so someone has a diversion from their regular life style. But the point I'm trying to make is even the news and information that we're allowed to believe and think is coming from corporations, and these corporations have become massively powerful. There's 6 corporations in the United States that control the vast amount of news and information that the U.S. population hears, and others around the world as well. That's just too much of a concentration of power in too few hands. And so you have in the United States, which developed now as an oligarchic economy, where 500 corporations control over half the economy and reap half the profits of all the companies in the United States. And as a result of that tremendous power in too few hands, they also have tremendous power and influence over politicians who make the laws. And therefore, we never play in a level playing field, and that the wealthier just keep getting wealthier because they have the ability to buy out and influence politicians. And so as a result, the average guy does believe that everything is kind of skewed against him. And the wealth inequality just keeps getting wider and wider. As it turns out, the ultra-wealthy apparently have most of their money in the stock market. That's their piggy bank. They also do hold quite a bit in bonds, which are more of a safety play. These are so-called high-grade bonds, not the junk bonds we talked about earlier. And the policies that are pursued by the central banks in the United States and Europe and Japan are all geared towards boosting the prices of stocks and bonds. And the vast majority of these financial assets are controlled by just 10% of the populations. And so 90% of the populations are not benefiting from this upward movement in financial markets, so only 10% are. And those who are profiting are spending some of their money, but a lot of it's being hoarded or reinvested. And so there's a very little trickle down to the general economy, which explains how we've seen booming stock markets and booming bond markets and stagnant economies at the same time. There is no trickle down, or very little trickle down effect from the ultra wealthy to the rest of the population. And as a result, you have what I call an oligarchic economy, and it's becoming what's known as crony capitalism, where the oligarchs can buy out the politicians and have rules made in their favor. And this is not just in the United States, but it's the same elsewhere. There's a lot of corruption just about in most countries nowadays. And so, anyhow, it is good to kind of at least realize that if we are talking about markets as we are today, the fact of the matter is only 10% of the population really has any skin in the game. The rest can only watch from the sidelines and wonder, whether it's just some type of virtual TV game show, but very few are actually involved in the market.
Gary,
but nonetheless, it's a very interesting story.
Gary, regarding some of these ideas, we talk about the opportunities that exist within the stock markets, within the oil industry and iron ore. Can any individual, part of the 90%, not equally be able to open a brokerage account and benefit from all these trends that are happening? Is the idea of having like oligarchs, the 1% or the ultra wealthy, more of a artificial glass ceiling that anyone at this day and age still has the ability to participate in markets to capture the same opportunities that exist for the ultra wealthy? Is it more of a awareness? And I think that's one of the key purposes of a show like this, that gives people the opportunity. If we're talking about excessive QE, someone that can be very pragmatic about this and can sit here maybe on the other side of the world or a developing country could actually still capture this opportunity.
That's absolutely correct. I work for a brokerage firm that was is the largest brokerage firm in the United States on retail level, and had several million households that had accounts. Several million households in the United States is also a very small percentage of the amount of households that are out there. The vast majority of people's wealth is in real estate, and I guess that'll continue to be the same. For those who do want to try to take advantage of government policies which are skewed towards the rich, all you really have to do is invest as if you were ultra wealthy and invest in the same markets as they do. And certainly the easiest way to do so is to open up a brokerage account and invest in maybe an index fund type of investment. And the stock market here in the United States has proven itself to be the long-term wealth generator. And I've been watching markets now for over 30 years, and I've seen dozens of crises that have triggered massive meltdowns in the stock market from time to time. And I've seen them all since Volcker's day, and I've written about them and traded in them. And I would say I see at the end of the day, as of just last week, when the stock market was hitting all-time record highs, it's managed to overcome all those crises and managed to go higher yet and hit record highs. In order to be successful in the stock market, which is your best bet for the longer term, you have to make a 20-year commitment that if you buy a fund today, you're going to hold it for 20 years. And within that 20-year period, you could very well find yourself down 10 or 15% or even more at any given point in time. If you hold on to it for 20 years, you will end up being a winner. That's been just based on past raw data, past trends in the marketplace. Even in weak economic times, the market can still go up because you're buying oligarchs. You're buying the nations that have all the rules skewed in their favor, and not only tax laws, but also international reach, where they are investing around the world and have figured out every way to avoid paying taxes. And whatever monies they are generating for profits are being rechanneled to shareholders in the form of dividends and share buybacks. And it's actually a shrinking market in the United States, where corporations have reduced the amount of shares outstanding by 10% due to their buyback activity. So that would be, that would be my advice. Now, not all stock markets around the world have done that well as the United States. So Japan, in particular, has been in the bear market for over 20 years and is back to where it was 20 some odd years ago. And China has had its boom and bust cycles. It's gone through a bust, and now it's starting another boom, reminiscent of what we saw in 2006 and 2007. So if you're going to go international, you have to also look at the long-term trends of every individual country, and not every government has the stock market as its number one focus of attention. Here in the United States, the U.S. stock market is the primary goal of the Federal Reserve to keep it propped up. But in other countries, such as in China, the value of the stock market is not that important as far as the government officials are concerned.
So Gary, let's talk about the U.S. dollar and the S&P 500 in this case. We've talked about the role of oligarchs, central banking, and their policies that benefit oligarchs. In terms of starting up a new portfolio right now, what can we do in terms of a position, say, for example, in the S&P 500? Do we see the markets continuing to benefit from relatively loose monetary policy? And do we see the U.S. dollar as the best currency in a very bad neighborhood?
Well, the U.S. dollar is the least ugly of the currencies. I would say the currency markets is what a reverse beauty contest. It's choosing the least ugly currency at the time. And we are in a situation now where the United States dollar is going up, not because of anything. Well, I guess part of the reason is the United States has now earned a reputation of being a petro currency, given its status as one of the world's largest energy producers, which is helping to reduce imports of oil and therefore improving our trade balance. But the Federal Reserve has stopped its quantitative easing policy, whereas last year the Federal Reserve printed $1.5 trillion U.S. dollars. Since November 1st of this year, in the last 6 or 7 weeks, the Fed has shut down its QE operations. And at the same time, the Bank of Japan is saying that they are going to pick up the mantle from the Fed and continue on with their QE operations, and not only continue, but to continue longer and even more extensive operation than had been previously assumed. So on October 31st, just as the Fed finished the last day of its QE money printing, the Bank of Japan announced that they would increase their QE money printing by 20%. And most likely continue it beyond March 31st of 2015, which was their previous date that they would halt They had announced back a few years ago they would run it through March of 2015. Now they're going to extend that for at least another 6 months. And as a result of that, simple logic would say if the Fed has stopped printing money and Japan is going to increase its money printing, then the yen will go down against the dollar. And sure enough, the dollar went from about 108 yen to about 119 yen. And so that trend will probably continue for a few more months at least, as Japan massively prints money and the Fed stays out of the money printing business. And Europe is going to begin its own QE operations. Europe has been trying to print euros and has basically been confining its activities to smaller credit markets in Europe. But if it really wants to get the impact that it's looking for, it's going to have to go to the broader, deeper government markets, which it's prepared to do. And it's already announced that it's going to print about €1 trillion next year. So that should weaken the euro. The euro is just under $1.25, and that would probably drop under $1.20 as a result of the ECB's money printing, and I predict the dollar will eventually hit 125 yen or even possibly higher. So the dollar will rise against the yen and the euro. As a result, the Swiss franc, which is tied into the euro because of the Swiss National Bank's monetary policy, will fall in line with the euro, and the British pound will fall in line with the euro. So there's 4 currencies all heading south, and then we have a whole bunch of other currencies which are commodity related, such as the Australian dollar, which is tied in with iron ore, and coking coal, that's top 2 exports. That is going down with the metals markets. And then we have other currencies like the Mexican peso and the Canadian dollar and the Russian ruble tied in with oil, and they're falling as well. And then the Brazilian real, which is also a commodity-based currency, also falling to multi-year lows. And the Chilean peso, tied into copper, is also at a multi-year low as the price of copper has dropped below $3 a pound. So the U.S. dollar rising against all currencies, and that should continue. And, of course, if the Federal Reserve actually decides it wants to start raising interest rates next year, even by a small amount, by 0.5% or 1%, that could have a dramatic impact on the currency markets and push the dollar even higher. And in the negative feedback loop, which you'd also see in the newsletter with charts and graphs, guess what? A stronger dollar has a negative influence on commodity prices, including crude oil. So a stronger dollar could just reinforce the drop in oil and help the Saudis keep the price down. So whereas the Saudis are doing their part in oversupplying the market, in order to keep it down, keep the price of oil down for an extended period of time in order to cripple the Iranian and Russian economies, the Fed could decide to raise short-term interest rates to use the dollar, stronger dollar, as an additional weapon to make that price of oil stay low. Of course, the risk for the United States in doing so is that you may have the shale oil industry going bankrupt, or a lot of these smaller companies defaulting on their debts. But guess what? The major oligarchs like ExxonMobil and Chevron will gladly pick up these companies at 10 or 15 cents on the dollar and then take over that industry as well.
Yes.
So
they had missed the previous
that could be the end result.
Right. They had missed out buying all these shale properties the previous few years, and this is a great opportunity for them to acquire some of them at these discounted prices.
And so investors should be doing the same. And so those maybe get some companies good long-term investments if the major oligarchs in the energy sector do fall in price in the short term. Then as they acquire these properties, they will emerge as the big winners as usual. and overcome their short-term adversity. And eventually the price of oil as well will not stay between 40 and 50 for a long period of time. I find that hard to believe. I do think this is more of a shorter-term nature, as we've already described, and if betting not 5 years out, you can look at, actually there are longer-term contracts out there which are interesting to watch. The December 2018 oil contract trading today on Friday, closing at $68.63. That's about $11 a barrel higher than the spot market. But that's telling us even 4 years away from today, the price of oil will still be under $70 a barrel. So that's still a new reality that's kind of hard to believe, being where we've been for the last 3.5 years. And I guarantee most people who go to the petrol station, the gas station, and to fill up, don't know why the price of gasoline's going down. They just see the price going down. If you read the newsletter or keep your eye on the markets, of course, you will probably be in the 10% that are in the know.
So Gary, what about the S&P 500 or U.S. equities in general? If interest rates starts to hike, how much period of time do investors still have to capture these new highs in the market?
Well, this will be one of the more fascinating situations going forward into 2015 is what the Federal Reserve will do with interest rates. And one could argue that with this collapse in oil prices and with the meltdown in the energy junk bond market, and with the strong dollar right now, that inflation will not be a problem in 2015, and there'll be plenty of Federal Reserve officials who are basically political cronies who have been selected by the White House because of their dovish backgrounds. They'll be arguing against raising interest rates in such an environment. No need to do so. And so, on the other hand, I do listen carefully to what the top Federal Reserve officials are saying, is they usually do broadcast, telegraph to the public at large what they're thinking through the media, and they use their jawboning to move markets. It's a powerful tool. Just words alone can move markets, as we saw in October. And so some of the more powerful members of the Federal Reserve are now preparing markets for a small increase in interest rates. And if my theory is correct, that they may want to strengthen the dollar even a little bit further in order to help anchor oil prices lower, in order to topple Iran and Russia, if that is the game plan. But all that's really necessary to achieve that objective is a small increase in interest rates to maybe 1% on the federal funds rate. From 0.25% today up to 1% should be more than enough to achieve that objective and push the dollar higher against all currencies. And would a increase of 0.75% be enough to topple the U.S. economy and push it into a recession, and thereby lead to a sharp decline in the stock market? One would have to argue, if you look at a 50 or 60-year chart of the Fed funds rate, it's highly normal to have interest rates near 0% for 6 straight years. We can afford to go up to 1% without hurting the U.S. economy all that much. Once again, though, keep in mind that what we just saw in the oil market, a lot of people thought the new normal was $100 a barrel that would last forever, and they made $250 billion in bets in the junk bond market. And even more than that, when you include bank loans, which are also several tens of billions that are not actively traded on markets. So those people were all fooled. They got the rug pulled from under their feet. And it's possible that there is a lot of betting that's been going on in the stock markets based on the idea that interest rates would stay near 0% for a long period of time. There could be a lot of leveraged positions in the market that had been bought with borrowed money, and even an increase of interest rates to 1% or 1.25% might be enough to scare a lot of people out of their positions in the stock market. And so, yes, it could actually cause a 10%, the long-awaited 10% correction at some point next year. Now, that would not be the end of the long-term bull market, which is going to be 6 years old in March. You can have a 10% correction along the way. In fact, it's a very normal thing. We have 10% corrections on average once every 18 months. We almost had the 10% correction in October. We just fell short of it. So now we have not had a correction in the U.S. stock market for almost 40 months now. And once again, they normally occur once every 18 months. So we are overdue in that respect on a historical basis. So my guess is sometime in 2015, the Fed will try to raise the short-term interest rates a little bit, and that could be enough to trigger a 10% correction in the stock market. Ironically, the bond market kind of likes the idea of a higher short-term interest rate. The longer-term bond market kind of likes the idea that if the Fed will raise the short-term interest rate to 1%, that it could trigger a 10% correction in the stock market, and that money from the stock market will have no place to go but to run for safety into high-grade bonds, I believe. So it's that would be another surprising event. But there's not much money to be made in bonds, of course, at these levels. The best you could hope to do is keep your money steady or earn a tiny interest rate given where they are now. Probably the best area for an investor, if they are in fixed income, would be to go into high-grade corporate bonds where you can get a little over 4% on a 15-year note. That doesn't sound very great, from a historical level, but I'm looking at the interest rates today in Switzerland. A 10-year Swiss government is 27 basis points, almost 0.25% for a 10-year Swiss bond. And in Germany, the 10-year yield is 62 basis points, and in France, 90 basis points. So you're getting less than 1% in Europe. So if you got 4% or higher on a high-grade corporate bond, a high-grade oligarch, then you'd be doing pretty good. And if the world economy does go into a long-term slowdown, then bonds could at least be a good place to hang out for a year or two. And then, of course, we always need to reassess market conditions along the way because there's always something going on that nobody thought about a year earlier.
That's interesting. One of the bigger positions we have is actually in dim sum bonds, Gary, which gives you the oligarch exposure with internationalizing currency that might actually have a few stumbling blocks along the way, but probably still on the same lines of what you're discussing about to some extent. Well, thank you very much, Gary, for all of this. It's been very insightful. Maybe we should cap off this discussion by just asking you like a very general question, which is, in all your years of covering markets, what is some insight that you've learned towards trading and investing? So far, we've talked about a lot of your observations, but how can we implement some of this stuff for the listening audience?
Well, there's commodities which are going cycles, and in fact, I would say commodities, industrial commodities, are still, at least to this day, give us better indications of what's going on in the global economy than, say, stock markets. Stock markets have become divorced from the global economy. Major companies can make even bigger profits in bad or good economic times. And quite often, the inflation that's caused by central banks is directed to pumping up financial markets. The commodities are more indicative of what's going on in the real economy. And so I would say that is something that we should all kind of keep in mind. The other thing was that for many years, the major U.S. investment banking firms were allowed to actively trade in the commodity markets. And as a result, they were able to convince a lot of pension funds and other mutual funds and big investors to look at the commodity markets as an asset class in itself. Created a lot of ETFs in that area and helped to lead to what is known as the commodity super cycle that we saw last decade. But they have since been locked out or being forced out of the commodity markets through legislation. And with their absence, we're not seeing the volatility or the boom cycles that we saw last decade. And so, for that reason, commodities have been weaker than maybe had expected. And look to the industrial commodities for trends of the global economy and even inflation. I personally use the basket of commodities, the continuous commodity index. I use the year-over-year change as my inflation indicator. I understand that commodities are just a segment of what people buy, but they still give us good leading indicating signals of where inflation's going. Right now, the commodity cycle is, commodity index is about 9% lower today than it was a year ago. So that tells me that we are in deflation, and central banks are trying to offset this deflation by printing even more money, but that printing money is not going into commodities, it's going into financial assets. So it makes it a very difficult chore to try to figure out with these conflicting forces. I would say, though, as I mentioned earlier, in the 35 years that I've been in the markets, and I've done a study going back 50 years, studying all the crises and the meltdowns, which people often worry about more than anything else, that even if you end up buying the market at the very high of a move, if you hold on to it long enough, and I'm talking about an index, not an individual stock, but an index in the United States, the Federal Reserve will bail you out over the long term and see to it that that index goes up eventually and that you'll come out ahead. That's been the conventional logic. That's called the Yellen put, the Bernanke put, or the Greenspan put, where the government now is almost guaranteeing that if you invest in the market and you hold on to it long enough, you'll earn a profit. It's that thinking that I find also, perhaps kind of dangerous. So, but it has worked out that way, I have to admit, and that's all I'm basically saying is that's how the market does behave. I would advise, though, of course, never to put all your eggs in one basket. Keep them spread out into different areas, including real estate and currencies. It also can be used as an investment vehicle, and we are limited to what we can invest our money in: stocks, bonds, real estate, precious metals, currencies, or certain commodities that may do well, or you could have made a fortune shorting the oil market if you were wise enough to see this event occurring. This was a heck of a move on the downside. So there's always opportunities along the way, but it is tough, and it's getting tougher. And increasingly, we're seeing now that more and more of the market movements are being directed by computerized algorithms, which is beyond the scope of human recognition and understanding, and where they integrate a lot of fundamentals and information and make buy and sell decisions faster than you can read an article. So one has to almost take a long-term view of something and hope things work out. You might want to just wait for corrections if that's what would make you more comfortable. And when you do see one, figuring you can buy an index fund, and even if you're going to not necessarily catch the bottom, that eventually it will reverse and go back up. And that whole theory is based on the idea that the government will continually devalue the dollar. It'll continually print money to monetize the debts, and the money printing is what makes the stock market goes up over the longer term. And the question is, what is your best investment vehicle for overcoming money printing by central banks? And from what I've seen here and now, it's been the stock market.
Thank you, Gary, for all that insight. Hopefully we can have a conversation sometime along the line and see how all these commodities and markets have unfolded. And maybe we can get more thoughts and opinions from you in the upcoming interview.
Okay, very good, Peter. I certainly look forward to that.
Thanks.
We hope you enjoyed this mastermind session. If you'd like to contact Peter Pham or Phoenix Capital, please email info@phx-cap.com.